It's an urgent warning. I'm your host, Steve Metre, and thanks for joining me today. In our lead story today, it's time to get out now as the government just initiated crisis protocols. And as you're about to see, when governments do that, it means we're at the beginning phases of what could be a massive crash in global equities. Now, let's head over to Bloomberg, where he picked today's story up with a headline, is China unexpectedly cuts one-year policy rate by the most since 2020. And this is an off-book cut. This isn't during their normal standard time where they cut rates or make policy changes. And this is a warning to the global economy that something serious is wrong, because normally when central bankers make policy moves, they do it at their regular meetings, not in between. The central bank decreased the rate of the medium-term lending facility by 20 basis points to 2.3%. The cut followed the PBOC's trim of the 7-day reverse repo, led by 10 basis points on Monday. The Monetary Authority has recently downplayed the MLF in favor of the short-term rate to guide markets in a way more similar to global peers. The issue here is, of course, this means that we likely will expect to see the yuan crash. We're likely to see the Chinese economy crash. But what does this mean for global equities? Why are they cutting rates? Well, let's take a look at, of course, the largest ETF for Chinese equity symbol FXY, and I want you to look back and you can see this peak way up here. Well, it's down more than 50% of its current value. You can see it's dropped significantly, and this is what central bankers are worried about. It's not just the economy, because when the economy goes, stocks follow, and that means when the wealth effects is done, the people will cut their spending in a major way. What they don't realize, as I'll show you, spending's going to get cut anyways, and there's nothing they can do to stop a crash in stocks. It's basically a coordinated effort across all key interest rates to ease monetary policy. It's worth highlighting this round of easing kicked off with a 7-day reverse repo, which may be a signal of its future role as the main policy rate. Well, what it means is when the government cuts rates, well, it means they're soon going to cut them again. But if you're looking to make money in this market while our subscribers are making a ton, let me show you our top open trade. This went on the books this month. It's a symbol ITB. Right now, it's up 9.75%. As the time of recording was up another 3% today. You want to beat the markets. We show you how to do that by taking advantage of machines. When they get offsides and in deep short position and prices rally against them, our report flags them, and then we go over every trade, tell you when to buy it, what to do with your stop losses. We give you everything. And if you don't want to beat the machines, but you like trading the technicals, but you just find yourself getting in late and out early, we look at the tactical momentum indicators over a 3, 6, and 1 month period, and we smooth it out with a proprietary overlay that gives us a unique edge. And when we see major pullbacks and shift of momentum, our reports flag as well. You get the daily reports, you get the tradable signals. I give you my opinion on the best trades. I tell you which ones I think you should do. I give you the stop loss levels. We track the trades and the returns, and give you a weekly update on the stop loss levels. And here's the best part. Unlike my friends who you cannot duplicate their trades, you can duplicate every single one of ours, and we give you 30 days to try it out for free, because that's how confident we are. Because the equity markets may be coming down, but there will still be opportunities to make money, and we're going to show you exactly which ones you should do and how to control your risk to keep from seeing a big plunge in your accounts. And if you look back at the federal funds rate at the .com bubble, when the Fed started cutting, the stock market was relatively high, but of course the market knew when the Fed is cutting, it's not a good sign, despite the belief of investors. That happened again going into the global financial crisis. The Fed starts cutting. The market at first says this is good, and then all of a sudden, no, it's horrible. Even starting into the pandemic, the Fed was cutting. The market was fighting it until, of course, a flood of money came in from stimulus. This time, to see the Fed cut at some point this year and likely cut more frequently, and what's going on with the PBOC doing it off color cut is just an indication the Chinese economy is in a dangerous situation. But they're not the only one, as you're about to see. We have some new information, but let's finish up here with China, because the PBOC string of rate cuts underscore authorities' growing urgency to support growth. And there's the bottom line. I told you before that they would be forced to cut rates despite the fact that the yuan was weakening, money was flowing out of the country. They would need to do something to stop it. Now they're in panic mode, which came in as worse than expected in the second quarter as faltering consumer spending more than offset an export boom. Of course, it's all about the consumer in every country. And what do we hear from these policymakers? That the services sector is going to boom, that consumers are going to spend. I'm going to show you why they're not and why what's happening in China is happening everywhere else. The central bank has refrained from cutting rates since late last year as it sought to keep the yuan exchange rate stable, which I said they had no chance to do. And here we can note, why do central banks cut? It's because of the labor market. And of course, we know the bond market gives them the signal, but when they ignore them, as the PBOC did, it tells us that the labor market in China is starting to come unwound. And even though we know the statistics there are not as good as we'd like to have them, it tells us that something serious is going wrong, because when we look at an increase in continued claims, as we see here in the U.S. data, what it indicates is people are losing their job and unable to find one, and as they cut their spending, well, it leads to other people losing their jobs, and that gets the attention of policymakers. You see the Fed cutting each and every time there's an increase in continued claims, with the exception of this time. And now we'll take a look, of course, in a little bit at continued unemployment claims. But if they start to break out to the upside, look for the Fed to aggressively start cutting to the downside. The announcement was unexpected because the PBOC typically conducts MLF operations in the middle of each month and had already drained it at 3 billion yuan of cash via the funds earlier this month when a batch of them matured. The PBOC provided 200 billion yuan at MLF on Thursday, the biggest net injection since January. So there you have it, a mid-month move and a massive injection of cash. It's telling you something is wrong with the Chinese economy, something's wrong with the banking industry. They're trying to plug the hole, but really what we know is when they do these off-book moves, it means there's serious issues. And in a separate statement, the PBOC disclosed that banks have taken up just 12 billion yuan of the 300 billion yuan quota for the affordable housing relending program as the end of June. And that is a huge red flag, because we know that China's banks are sitting on a massive amount of property debt, and they're trying to get these banks to take some of this money, clean up their balance sheet, and put people to work. And the fact that banks are not pushing this money out and property lenders don't want it is an indication just how bad the Chinese economy is. And this allows the central bank to provide cheap funding to lenders if they issue credit to help local governments buy unsold homes and convert them into subsidized housing. Clearly, what that's telling you is they don't want to do it. They think the risk is too high. And that program is a major part of a broad property rescue package that's clearly not working. As I said, it wouldn't. Unveiled back in May, which is yet to have any material impact on reversing the slump in home prices. And now you see why the PBOC is stepping in. And what this has started is a catalyst of selling across global equity markets. Now let's turn to Zero Hedge, as they note what happened in the U.S. this yesterday is 25 billion in CTA liquidations triggered as long only sell, but hedge funds then came back in today and started buying. And statistics aside, according to BNP CTA and volatility target models, now if you're not familiar with CTAs, this is the machine positioning that we mimic and beat. So of course we got our clients out ahead of time, as yesterday's minus 2% close has triggered a greater than 25 billion selling flow in U.S. equities, and all else equal, both vol target and other strategies will likely turn to sell if stocks continue to go down and volatility goes up. And that's the risk that BNP is saying here, is that CTA selling could soar unless an aggressive dip higher emerges. Now, what's the problem is we talked about this on Sunday. We go back to that show, and what did we find out from Goldman? August is the worst month of the year. Money goes out of the market during August, flows dry up, and is setting up a downward move in the market that could get accelerated as the machines start selling and people start panicking. And of course, the economic data coming out of China and the PBOC's move suggests that things are not good at all. And additionally, today CTA dump follows the first of selling flows from systematic strategies observed in last week in a long time. However, and this is very important, they were offset by large buying flows in ETFs. The 1 month inflows into U.S. equity ETFs peaked last week at $80 billion. But remember, this is what Goldman says happens, and then it peaks and rolls over. At the moment, it's hedge funds that are propping up the market. The question is, can they? Because as we turn to Germany, we find out that things are getting even worse there, just as we suggested they would. As German business expectations fall, deepening a rebound worrying. Here we see the IFO expectations drop to 86.9. Of course, economists and experts thought it would go up. And this, of course, defies predictions for a slight improvement. We said when this rolls over, it's not turning higher, it's headed lower. The gauge of current conditions and overall measures also decline. Here you see these sentiment indicators. This was followed, of course, by the S&P Global, as German business confidence now is deteriorating, and there's a lot of pessimism regarding the coming months. Remember, the political elite said we're optimistic. We think things are going to turn around. And what do we look at the data? What does it tell us? That consumers aren't spending. The services sector isn't driving the business that everyone hoped it would. And when it doesn't, they cut down on their new orders because businesses aren't selling as much inventory. And when new orders go down, backlogs start to get cleared out. And when the backlogs are gone, well, next thing you know, employees go with it. The overall outlook now is rather bleak for Germany. Of course, they'll add that to the list, and that's China as well, as the decreasing business confidence adds to Wednesday's unexpected plunge. Of course, I love that, of S&P Global Purchasing Managers Indices, highlighting the difficulties of Germany's economy to recover after 2 years of near stagflation. And that is the issue here, because you don't recover. The problem is, as we looked at this chart yesterday, you see rising inflation, so rising consumer prices against people losing their job and unable to find work. So those on unemployment who have their paychecks cut to begin with because they're now on unemployment can even get less money because inflation is rising. That leads to further reduction in spending. And then, of course, more people hitting the unemployment line. You see this leads to a recession each and every time. The problem now is we know that the Chinese banks are insolvent. We know in Germany they have a commercial real estate crisis. Here in the US we have a commercial real estate crisis that no one wants to admit. And all of a sudden you start to see the beginning stages here of one central bank panicking. Soon there'll be more. The recent weak economic indicators put a big question mark over the significant economic recovery that many economists expect for the second half of the year. And I'm telling you, it's not coming. Only an anemic economic upswing. That was all it was going to be worth. And now we're going to see the next big move down. And you wonder why U.S. equities are falling. It makes perfect sense. Hedge funds are stepping in, trying to put a bottom in here. But reality is they can't stop what's changing in the economy. And here we can look at what happens to the consumer. This is why the services sector is not going to be the savior that everyone is pinning it to. Because when we look at inflation-adjusted retail sales, that's shown in blue, as people hit the unemployment line, well, what happens, their spending naturally goes down, which leads to, of course, a feedback loop of more people losing their jobs. And you see that during both of the last recessions. And look at this rise in claims here. And while this hasn't gotten the attention of the Fed, it's certainly got the attention of retailers who are seeing negative year-over-year comps on their sales because they're not keeping up with inflation. Yes, people are spending more in terms of dollar amount, but they're not actually buying enough products. So their price they're paying is higher, but their over volume of sales is down. That's an issue. And that means the U.S. labor market is soon to unwind. As we look at continuous jobless claims now hover at 32-month highs, we see initial claims drop modestly from 245 to 235,000 last week. But what we care about is those who are on unemployment are staying there. Are we seeing them get jobs? Well, according to the government, 9,000 of them did on a seasonally adjusted basis. This fell to 1.85 million on a non-seasonally adjusted basis. It did drop a nice 24,000, but still remains at an elevated level of 1.921 million. If this number stays up there and even worse continues to rise, well, what it means is those initial claim numbers are going to skyrocket. And here you can see, because you want to mind the gap when it comes to unemployment claims, you see initial claims here in blue against continued claims. I've highlighted the gap between them because what I want you to see, as continued claims turn higher and the spending power of people on unemployment drops, it leads to other people losing their jobs. That's the risk here. What we're likely to see if continued claims stay at this level or even worse, move higher, watch out. And by the end of summer, and of course the next Fed meeting in September, what it means is we're going to see initial claims move up, and you're going to see not just a PBOC panicking, you're going to see the ECB and the Fed and every other central bank following suit with rate cuts. And for the equity markets, that doesn't mean good news. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.